Hi guys, welcome back to the channel. My name is Dave, this is Wealth Adventures, and today I'm going to try to answer the question for anybody that's new to options. I just bought or sold an option, it's in my account now. What can I do with this thing? Do I close it out? Do I roll it? Do I wait for expiration? So if you're new to options and you're trying to figure out an answer to this question, I hope to provide you some information. So if that is what you're looking for, please stick around. Whoop! So before we jump into these examples, let's talk about what makes up the value of an option. And there's three primary things. The first one is the value of the underlying security. So let's talk about Apple, for example. Let's say it goes up in value. Well, any call option that you might have purchased would go up in value, right? The same token, any sold put against that, if it goes up, is kind of good, right? Because you collected all that premium. And as long as it doesn't go down below your strike price, you're going to keep all that premium. So those are both bullish scenarios where you're hoping the stock goes up. Whereas if you are a buyer of a put or the seller of a call, those are bearish scenarios. But all this price action moves around and changes the value of that option. The second big component of an option is time value or theta decay. So as time ticks away, you start to lose the value if you're the buyer of a call or put, because there's an expiration date hanging out there, right? But if you're the seller, and this is why I like to sell puts and calls, I'm collecting that time value. Time is on my side, and I like that. So that's component number two. And the third component that makes up the value of an option is IV, or implied volatility. And the best example of increased implied volatility would be when you're trading across earnings, for example. So let's take Apple, right? If you're going to trade across earnings 4 weeks out, well, you're probably going to be able to collect, or you will be able to collect, a larger premium once you include earnings, because IV is going up, right? Who knows what's going to happen? So if you're the seller, you're going to collect a bigger premium. If you're a buyer, you're going to have to pay a little bit more because that IV is going up. So those are the three components. So as we go through these examples, keep those things in mind about how this will affect the value of your option. So let's jump over to Fidelity and take a look at some positions and start to think about how we could handle these positions at this point. For me, one of the things I like so much about them is just how flexible they are, how you can use them in so many different ways, let's say. So makes it kind of exciting. So I wanted to show you some examples today with ticker symbol DOW, Dow, right, a chemical company. And these are different options that I've purchased over the last few weeks that all expire this coming Friday. So this is the weekend. Markets aren't even open right now, but I figured this was a good way to kind of look at it together. So ticker symbol DOW, and this is the 1 year chart, and you can kind of see that it's kind of settled into this $55 to $60 range right now. And as it's been dropping here, I started to open up some different put positions. So these are sold puts. So I have one here at $53, one at $55, and one at $59. They all expire this coming Friday. Okay, and they were purchased at different times. So as the stock was dropping, I bought more. So this one was on 9/7, and it's a $59 put. You know, about 10 days later, I did the $55 one. A couple days later, $53 put. And different amounts of contracts. This one's 3 contracts, this one's 2 contracts, and this one's 2 contracts. And you can see my cost basis over here. So because these are sold puts, I get to collect a premium, right? And this is that premium. So as soon as I sold this, this is what I got to put in my pocket. $255, $130, and $118. That's my money. That's in my account now. Now, where these stand right now is based off this price, obviously, and time and IV, or implied volatility. So right now we're at $58.58. So these two are still what we call out of the money, right? Because the actual strike price is well below the current price, whereas this one is just in the money for the person that owns that option, the person that bought that option. So it's got some built-in value right now, or what we call an intrinsic value. So the tail of the tape right now is I got to receive $118 right now. If I wanted to close this out right now, which I could say buy to close this $53 put, it would cost me about $20 to close it out, which would leave me a gain of about $98.63. These are just estimates, but about that profit, okay? Same with this one, 130. And if I wanted to close it, it would cost me $34. So I would make about $100. Okay, all good. Final one, I received $255. If I wanted to close it, it would cost me $384. So I would lose $128. Okay, so that would be an example of if I just went to buy to close each one of these. Make 100, make 100, lose 128. Okay, that is the current position for these three. So if I wanted to settle up these right now, I would simply click buy to close, because you have this contract, right? I'm going to buy to close out this contract. And for that, I'm going to have to pay about $20, which means I'll have a $98.63. So that's buy to close. Do I want to do that? Do you want to do that? You have to determine that for yourself. There's not a lot of meat on this bone left, right? So I've got 1 week left. And by leaving that put out there, I have the risk of Dow dropping a lot and maybe ending up getting put to me at $53. But maybe I want that too. So this is the crux of the situation, right? Do you want to have that put to you at $53 a share? Well, I kinda, maybe, you know, that's a determining factor here. But the fact that you have this open and you're only going to make $20 off this $10,600 of collateral that you have out there, right? Because 53 times 200, two contracts, that's $10,600 of collateral that's hanging out there to make $20 this week. Do you have a better place to put that money that you might be able to make more this week? Probably. So that's probably why you would want to buy to close to free that capital up so you can put it into something else, because I'm not trading on margin. I'm using cash in these positions. So this is probably one that I would just want to buy to close and look for greener pastures where I could make a little bit more off my money. All right. Now, the same with the second one. It's kind of the same position. $130 originally got, and it's only about $34 of value this week. And it's a $55 put. So doing buy to close, utilize that money somewhere else? Yeah, probably, right? But this last one, so $255.94, it's got a $384 current value. So I would lose money if I went to close it right now. So this one gets kind of interesting, because do you want it to be put to you? If it doesn't move at all, if this doesn't move at all, it stays at $58, and let's round up to make it simple, $58.60. That means when it gets put to you, and that's just isolated at that price, then come next week, when I actually have this in my account, right, I am going to have to buy it at $59, even though it's only worth $58.60. So I would be losing $40 per 100 shares times 3, $120. I'd be in the hole for $120. But I guarantee I could get that right back if I turn around and said, sell to open, right, the covered call on the other side of this, because I would now own the stock. So that is an option for this option. You can just let it go to expiration. It gets put to you, you turn around and you sell the call option. But one of the things that I love so much about options is you don't have to just buy to close. You don't have to just wait for expiration. You can do things like roll. You can do so many different things. And when you're talking about rolling, it is simply buying to close and selling to open. But when we look at this, your perspective will change. This is going to give you some insight into how options truly work. It's going to make your brain think a little bit, and you're probably going to get some great ideas out of this. So let's look at rolling this option, which is simply buy to close, sell to open, all in one step. But the interesting part here is when we do this, maybe we can get a net credit, based off of our current cost basis, maybe put some more money in our pocket, go out a few weeks, and continue to push this option out. So let's look at rolling. I'm going to click roll. It's going to take us into this other trading screen. It's going to show us both steps of this option, this rolling option. So what we're looking at is this is us closing out the option. Buy to close 3 Dow October 8th, 2021, $59 puts. In order to do that, right, it's going to go between $1.14 and $1.29. So the ask price is about $1.29 per contract. So $129 per contract. We've got 3 of them. But at the same time, we're just going to reopen another position. We're going to sell to open 3 again, and we're going to go out maybe just a little bit further. So this is our original expiration is October 8th. We're going to go out to October 22nd, which is going to also include earnings, which gets really interesting because then we're adding volatility. Implied volatility means that your premium should go up because you're exposing yourself to additional risk because earnings can freak a stock out, right? So for sake of argument here, we're going to go right back to that same $59 strike price. And for rolling this out 2 weeks, you're going to get about $2 per contract, between $2 and $2.22. Okay. So down here, you're going to see an order type, and it should default for you to whatever the correct answer is. So in this case, $2 is greater than $1.29, so it's going to net credit. Okay. And otherwise, it's net debit or even. So we're at a net credit. We're putting money back in our pocket, and we're going to say net bid for, again, sake of argument. We're saying we want to execute this if we say net bid, because it's going to automatically take the best price it can get, whatever is market price, essentially. So if we're doing this right now, time and force day, cash, conditions none, we're going to put $209.10 in our pocket because it's a net credit to our account of $209.10. So that sounds pretty good, right? Same exact strike price, rolling it out 2 weeks, and it's going to get put to us maybe at $59 because it is still at $58.58. So another 2 weeks go by and then this doesn't change at all. We would have our $209 and it could be in the same exact scenario where we would repeat the same thing. So that is one way to look at this option if you wanted to roll it out. But like I said, these are very diverse. There's lots of flexibility in here. So let's modify this a little bit. Let's say $59, too rich for me because it's already trading at $58.58. So if you wanted to take some of that value off the table, off this to $109, and you wanted to look at the $58 strike price, well, that's going to be able to pay you $159 per contract. Okay. So again, net credit, let's say with a net bid, right? And it's going to say, well, if this executes at $1.29 and $1.59, you're going to get $88.05 after paying your little fee. It'll probably be better than that because you see a pretty darn big spread between this bid and this ask, and this bid and this ask. So it's probably going to be closer to 120 bucks or so, maybe $150. If you just executed it like this. And again, you don't have to say net bid. You could go midpoint. So in that case, it would be $50 a share. I'm sorry, $50 per contract, 3 contracts, so right around that 150 bucks. So that's another interesting way to look at this. So I could go out 2 more weeks and I could lower my original strike from 59 to 58, and I can collect $88 in premium. So now that's pretty exciting to me because when you start looking at these and you start looking at flexibility and basically say, I get to pay less for this, 100 bucks per contract. Yes. And you get to roll it out 2 weeks and you get to collect $88 put in your pocket. Well, that's pretty exciting, right? For an option that is in the money, this looks pretty promising, right? Maybe this is the way you want to manage this option. Maybe this is the way you want to control it. So again, just different ways to look at options. Hopefully this opens up your mind a little bit to the opportunities that are out there when you're trading options, and when you have an option that's open, how you might handle it. So the point I really want to illustrate today is that just how flexible and fluid options are. You're not always going to come out a winner, not always going to come out ahead, but there are ways to manipulate, move around, and adjust, still come out ahead. So look for those opportunities, and hopefully that works out well for you. Of course, if you have any questions on this stuff, just ask down below. But those are examples of how I would buy to close a current position when I have a sold put, or roll a position when I think it might make sense to roll. Now, this also works if you are if you're trying to sell covered calls, or if you're a buyer of puts and calls. You can still manipulate this data the exact same way by buying to close a position, or sell to open new positions, or roll these into new positions, I should say. So just to illustrate that in a couple ways, here is a Dow $65 call. So I have 600 shares of Dow that I've already accumulated, and I just sold those. I sold the contract covered call out on 9/27 for an expiration of December 17th. For that, I collected a $600 premium, which is I already have a little bit of a nice gain there. If I wanted to close it, it would cost me $450. So right now I'm just letting time decay work in my favor, theta decay. And we'll talk more about option Greeks, but as time ticks away, I get to collect that premium, and I'm happy in this position, even though the stock right now is at $58.58, and this is all the way up at $65. For me, that works out well because the Dow pays a nice meaty dividend, and that dividend is going to become qualified. So even if I own this for another year, 2 years, and while it's trying to get back to $65 a share, I'm not too upset about that because I like this position actually. So in this case, I'm just going to let time tick away. Hopefully they'll pay me some qualified dividends, which are going to be taxed at a lower rate for me than this premium that I'm collecting. So lots of ways to play options. But again, if you have any questions on this, please just ask down below. And I do want to show you that you can do this with puts and calls that you want to buy as well. Now, as I've stated, I am a seller of puts and calls, but every now and then, maybe 1 in 50, 1 in 100 transactions is actually a bought put or call. It's just not something that I like to do personally. It does not work out for me very well, but got to take a gamble every now and then. So, and since we're talking about gambling, I went with WYNN Resorts. So this is one that I bought a few weeks back. It's an $85 call. It was pretty much at the money. So WYNN was trading about $85.50, right? So an at the money call. And that cost me $676.68. And the current value is $582, even though that WYNN has now gone up to about $87 a share. But I've lost because of, again, time decay, theta decay. So I'm on the losing end right now, but I still have time because it goes out to October 29th. So I could take this off. If I wanted to take it off, I would simply sell to close it, and I would get about $582 for this option, which means I'd have about a $100 loss, right? Does that all make sense? That would be me saying, I capitulate, I give up, I sell to close, and I'm getting out, right? So that's one way to handle this, right? Because I'm out of the money. Now, if it shoots up, maybe this week, and I have some value, maybe I'll close it out and run away. But again, you can also roll. So rolling this option would look a little bit different. So again, what's your objective with this option? Well, I don't know what the best way to illustrate this is, but pulling it up here, let's say we have sell to close, one win. So again, if I wanted to close this out, it's going to cost, or I'm going to put $555 in my pocket. But I could also buy to open another position. Let's say I believe, just for sake of argument, let's say I believe that this week it's going to shoot up to that $85 price, way past that, right? Just as an example, right? So then again, we can do a net credit here, net bid price, and it's going to pay me $208.70, okay? So essentially, I'm giving up time, October 29th to October 8th. I'm basically saying this week, this stock is going to take off, right? But I'm kind of hedging my loss a little bit because I'm taking off $208. So as soon as I do this, I'm going to be able to put a couple $100 in my pocket and basically reduce my cost basis, right, by about $200. So now I'm down to $470. And let's not forget either, if it just maintains its current price of $87.21, then on Friday of this week, if I wanted to buy to close, it would have $221 of value, right? So I'm kind of taking off some of the risk, but I'm shortening my time span here of where I can actually make a profit on this. So again, just one more way to illustrate how you can play around with options and how flexible they are. Any questions, let me know. All right, so there you have it, at least a couple examples of how I might handle a situation once you buy one, or at least the anticipation. If you're brand new to options and you're anticipating your first buy and you're wondering, how will I handle this once it's in my account? Hopefully I answered some of those questions. But if I happen to create a bunch more, don't hesitate to ask me down below. I will be sure to get back to you and answer you to the best of my ability, or at least share my opinion. So I really appreciate you watching. If you wouldn't mind, please like and subscribe. Love it. And we'll see you next time. Have a great night. Take care. Whoop!